Well, good morning and welcome everyone. Good morning, Jen. Thank you for saying good morning to me. Um, if anyone can hear me, just let me know. That'd be great. I am James Orr. Looks like people can hear me. I am James Orr, and today we are doing real estate investor story time. And it is a super interesting story. A lot of our stories have to do with folks that are using real estate. That are investing in real estate, and a lot of them are looking to achieve financial independence or retire early. Today's story is slightly different. Today's story is sort of like the countermeasure, the yardstick against which we measure the real estate investing parts of our story, because the story that we tend to see is real estate versus stocks. And today is a story about investing in stocks and why somebody would consider investing in stocks and what that might look like. And so today we're talking about Plain Jane. And Plain Jane is a cog in the bureaucratic machine. Just another worker in a large bureaucracy. Hates her job. Well, I wouldn't say she hates her job. She heavily dislikes her job on many days. There are a couple days when it's okay. She sort of gets by. There's a couple of people there that she thinks are pretty cool. You know, a couple of people that she can live working with. It makes it bearable. A lot of people there. She's like, nah, not sure. I really like these people. Not sure I'd want to deal with them if I didn't have to come in and wasn't being paid for it. She earns about $40,000 a year, and she saves about 15% of her income. She wants to achieve financial independence. She wants to be able to retire, ideally early. And in fact, she did consider real estate investing. She's like, what's all this? I hear about this all the time. I see these books. I see people on Facebook talking about, getting rich in real estate. And, so I actually went and I looked at this stuff. I looked at this real estate stuff. And when she looked at it, what she saw was I could get about, I don't know, 5, 6, 7%, maybe a little bit more cash on cash return on my money. But I could get, similar, maybe even slightly better returns, maybe the same returns investing in stocks. And with stocks, it's much less active. I don't have to go and babysit properties. I don't have to deal with clogged toilets or doing repairs on properties. She starts thinking to herself, it seems like the returns I could get, even when the property's paid off, if you look at cap rate is the return you're getting, your cash flow on your property when the property doesn't have a mortgage on it. She's like, the return I get investing in this real estate stuff, it's not like it's that much better. In some cases, not even better at all than investing in stocks. So why should I bother? Why should I put in all the effort? Seems like it's such a more active investment. And what occurs to her one day when she's thinking about buying real estate is, and by the way, for this story, you should know I am extremely pro real estate. I'm just sort of playing Jane's side and telling you Jane's story. So Jane says, if I need to get out my money, if I go and I save up money and I put 20% down in the property, and then something happens where I need to sell that property, it's a pretty big hit to my capital to get at that money. If I go and I save up 20% and the next month something comes up and I need to get out of that property, real estate's not super liquid. And in order to capture my 20% that I put down back, it might cost me 7% of the value of the property. It's not 7% of my 20% down. Oh, no. It's 20% of the value of the property and 7% of the value of the property in a lot of cases if you're using a real estate agent to sell your property. So she squints really hard and she says, that's about a third of the cost of my money in order to get at it. So if I had put, let's call it $60,000 down, bought a $300,000 property as an example, and I needed to get back at my money, it might cost me $21,000 just to get my money back. I'm like, I only have $40,000 left. So she's like, it's not liquid. It would cost me a lot of money to get at it. The return I'm getting, her return on equity calculation is really what she's looking at. She's like, if I've got this chunk of money invested here, what's the cash on cash return I'm getting on it? And over time, yeah, my equity increases, but my cash on cash return for the return on equity, not return on investment, return on equity is about the same. And even when the full thing's paid off, it's cap rate. which isn't that much better, if at all, than investing in stocks. And then there's all the active work I need to do. So, I don't know if I'm interested in real estate. Now, she didn't take into account the 4 areas of return that we typically discuss when you buy a property using the return on investment quadrant or return in dollars quadrant. I'll show you that for a quick second here, because I think it's important. This is the part that she's missing, right? This is the part that she's really not considering. So this is just a property that she's buying to live in. In this case, cash flow is break even because she's not buying it. But these are the 4 areas of return we typically talk about when someone invests in real estate. And the area of return she was really concerned about was this one right here, the cash flow portion of it, which ignore that it says 0 in this example. She thought she would make money on a rental. She thought she'd be in that 5, 6, 7, 8, maybe 9, maybe 10% cash on cash return. But when she looks at it and compares it to investing in the stock market, she's like, it's about the same return, but there's all this extra work. She was ignoring in many ways the appreciation, the component, the fact that her tenants are paying down that debt on her property, and the tax benefits. So she was sort of like simplifying that. And honestly, who could blame her? Until you really dig in deep on this whole thing, on real estate investing, you may not, from a quick cursory assessment of it, you may say from the outset, stocks, real estate, cash on cash return, similar, a lot more work, less liquid. Maybe I'm not interested. That's part of the problem for her. Is she's like, I think just stocks are better. Okay? So she considers that. I think I talked about that. Oh, the other thing is she doesn't have the stomach for leverage. It stresses her out. Credit card debt scares her. She doesn't like it. She doesn't like owing a lot of money. She doesn't like having debt on properties. It's a point of stress for her. So she's discouraged from taking on additional debt. Maybe she heard a story when she was younger from her grandparents. Debt is evil. Don't get into debt. Don't owe money to anyone. Okay? Maybe that's what her story is. So we talked about that. So she opted to invest in stocks. And so she happened upon, how much money do I need in order to be able to retire? How much money in stocks do I need? And so she was digging around online forums, doing some research. She's like, if I'm going to make this as a plan and a goal, I should probably know a little bit more about this. And she stumbled upon the Trinity study. realestatefinancialplanner.com/Trinity will take you to the link to the actual study itself. realestatefinancialplanner.com/Trinity, if you want to write that down, if you don't have access to the recordings of these. And this is a report by 3 professors from Trinity University: Philip L. Cooley, Carl M. Hubbard, and Daniel T. Walls. You should read this, okay? It's an important concept in planning for how much money you need in retirement, especially if there's even the smallest part of you, the tiniest piece of you that thinks, eventually I might sell off all my properties, take all the money, invest it in stocks or bonds or whatever it is, and live off of the proceeds. At some point you think, I don't know if I'm going to want to manage all the properties. I don't know if I'm going to want to have properties like throughout my retirement. If at some point you think I might possibly, the smallest part of me thinks I might actually sell my real estate and convert it to stocks and bonds and live off the proceeds, you need to read the Sustainable Withdrawal Rates from Your Retirement Portfolio, aka the Trinity study, which is quoted online all over the place. And so I'll summarize some of the key parts, but it's really important that you read it. It's not that long, 12 pages, and probably 4 or 5 of those pages are charts, like tables. So here's basically what they determined, and I may be butchering it, so go read it and get all the details. But the basic idea is they said, if you have a chunk of money and you're hitting retirement age, in this case 65, 70, whatever it is, and they say, and you have a 30-year time horizon that you need to provide yourself with money to live on, and the 30 years is important. We'll talk about that in a minute. How much of your portfolio, of the initial amount of your portfolio, can you safely withdraw so that you're not likely to run out of money? And what they did is they went through a whole bunch of stock market data and bond market data, and they determined which, like if you ran through a whole bunch of different scenarios, which ones you ran out of money with and which ones you had enough money to do that. And there's some tables at the end that show you how successful they were. And so, for example, here's one table. This shows you the success rate taking monthly withdrawals using data from 1926 to 1997. The report's not new. That's why it's 1997. And there are people that have updated this with more recent data. But it shows you if somebody were to take out 4% of their portfolio at the very beginning, so if you had $1 million, you're taking out $40,000 a year, you're taking it out monthly. Over 28 years, 98% of the time, you would not run out of money. I'm going to pause for dramatic effect here. Because what it just said is 98 times over a 30-year period, you did not run out of money. That means 2 times out of the 100, you did run out of money. Close your eyes for a second, since this is story time, unless you're driving. Close your eyes for a second and imagine you're now 80 years old. You retired at 50. You're 30 years into your retirement. You're 80 years old, and you wake up one morning and you ran out of money. You have no money left over. And in this case, even taking 4%, you only ran out of money 2 times out of 100. 2 times out of 100. Would you like to have a 2 out of 100 chance that you're going to have $0? You're going to run out of money in retirement. That's kind of scary to me. Okay, but that's sort of what this safe withdrawal rate stuff is about. So here at table 2, though, this is the one that Plain Jane is looking at. She's saying, hey, this is the one that if I adjust the amount I'm taking out, if I start with $1 million and I take out 4%, but I adjust my $40,000 a year, the 4% that I'm coming out, if I adjust that for inflation over time, so each year it gets a little bit more, so that I'm really taking out $40,000 in today's dollars each time. Of course, the portfolio is increasing. But if you're doing that and you take out 4% safe withdrawal rate, which is the 4% per year, but you adjust that for inflation, over a 30-year period, 98% of the time, that's good enough. And for some reason, she thinks that's acceptable. And a lot of people do. A lot of people say, hey, that seems reasonable to me. A 98% chance of success, sign me up. Me personally, I would rather see 100%. I'd rather overfund, take out less than 4%, and have it be a more sure thing. Because I don't know, the idea of working at Walmart as a greeter at 80 does not appeal to me. I don't know. Maybe some people like that. Maybe you want to get out, get a little socialization. Not my thing. Okay? So if she had done 3% safe withdrawal rate, according to the data from 1926 to 1997 in the Trinity study, she would have had 100%. Now, here's another interesting thing. This is using historical data, right? The Trinity study talks about historical data of 1926 to 1997 stock market data and bond data. Does the stock market always perform the same? Is the 1926 and 1997 going to look exactly like 2020 to 2100? Not a chance. 0 chance that they are going to be identical. I can assure you of that. There's no way we're going to have exactly the same performance. Okay, so it's going to be different. It's going to be random. There are going to be years where we have a coronavirus and the market loses 30% of its portfolio value. They've recovered so far. Maybe we see a dip again. Who knows? Okay, so what if she had saved up her $1 million and then the day after she retired, COVID-19? Now she's down to $700K. Really tricky, really tricky. By the way, if anyone has questions, don't raise your hand. Just go ahead and post them into the chat window. I'm happy to answer those. Okay, so she starts looking at this. She's like, okay, I buy into this sort of 4% rule sort of thing. So how much money does she really need to save in retirement? Well, she's making $40,000 a year, which if my math is right, I'm going to pull up my calculator. I'll do a little math with you, just make sure. So she's making $40,000 a year, divided by 12. So she's making $3,333 a month, but she's really saving 15% of that. So really, she's living on $2,833. I'm going to round up with that. Melissa says, my connection keeps dropping. Will the recording of this be sent over to us? The recording is for premium members only. So it's for paying members. That's the way that we've got it set up right now. So we are recording, but it's not just going to be automatically sent to everybody. So I said $2,833 looks a lot like $3,000 a month to me. So I think in our modeling, we said, hey, listen, she needs to save up and have $3,000 a month. So if she needs $3,000 a month, where's my calculator again? I'd lose it. I got distracted. $3,000 a month times 12. It's $36,000 a year. Now, using the 4% safe withdrawal rate, if we divide this by 0.04, it'll tell us how much money she needs to have saved up in order to be able to pull out 4% and live kind of safely. Melissa said, I'm sorry, can you say that again? Yeah, so the recording is happening. We post it up to the premium members website. So you have to be a paying person in order to get access to the recordings. So sorry about that. Sorry, it's dropping out on you. So in order to do this, she would need to have $900,000 saved up in order to do that using a 4% safe withdrawal rate. So really, she's trying to save up $900,000, making $40,000 a year, saving 15% of her income. That's her kind of like model, right? So here's one of her considerations. She thinks to herself, should I rent or should I buy? And here's some of her thought process. Yeah, and GN says, and that doesn't account for inflation. That is absolutely correct. That is absolutely correct. Really good point, GN. Yeah, and our software does model for inflation. But you're right. That really rough math that she did not account for inflation. Okay? So here's what she's thinking. She's thinking, should I rent or should I buy a house? And here's her thinking process for this. She says, if I rent, I was looking at this real estate stuff and I realized all the real estate investors are saying, I'm going to keep increasing rents with inflation over time. So she says, I'm probably also going to have an increasing rent on my property if I'm going to rent from someone else. So my rent is going to be going up with inflation over time. So it's not like I'm going to be able to lock in my rent today and it's going to stay fixed. My rent is also going to be going up. So my expenses, my food money, my insurance stuff, if I have a car payment, all that stuff is going to be going up with inflation over time. So if I rent something, then my rent will be increased with inflation as well, and I'll be always spending that same amount of money. If I buy something, in a really, really simple world, she imagines herself, if I buy something, at some point in the future, 30 years, let's say, in the future, the house is paid off, and now I don't have at least the principal and interest part of that payment. And so she starts thinking, well, that's pretty interesting, because if I'm going to retire in 20 years, 25 years, 30 years, at some point in the future, if I don't have the principal and interest part of my payment, I'll still have taxes, I'll still have insurance, I'll still have maintenance, and all of those have increased with inflation. But I won't have this major principal and interest part of my payment. And so my expenses, what I need to live, would actually be lower. So if I really am trying to live off the same dollar amount, if I'm still trying to live off that $3,000 a month, but I no longer have a principal and interest part of my payment, I actually have a higher standard of living. Think about that, right? She said, I have $3,000 that I'm planning on living on even in retirement. And part of that right now is going toward my principal and interest payment if I buy a house or rent. And if I don't have the principal and interest part of the payment because the house is now paid off, then really I have that much money extra that I can now spend on travel, medical bills if I have medical bills when I'm older, doing more fun stuff, gifting money to friends and family, whatever it is that makes her motivated, donate to charity. She can do whatever she wants. And so it occurs to her that mathematically, it's probably better for me to buy, especially if I'm willing to live below my means or at my means, and only buy a house that would have about the same cost as me renting. So if I were an investor and I bought a property with 100% financing, what would my total cost to run that property? Principal, interest, taxes, insurance, maintenance on that property. There's no vacancy. She's living there. But she thinks about that. If that amount, the amount of her monthly expenses on that property are the same as what an investor would pay in order to buy the property, then she's okay with that. And so she decides to pick a property and buy a property in order to, all right, Adam, I'm going to ban you because you're soliciting in the middle of my presentation. Okay. So Adam has been banned because he was soliciting people in the middle of my presentation as if this was a business opportunity for him. So let that be a lesson to you guys. All right, back to my story. So she decides, I'm going to buy this property. And there's some really interesting charts here that go into this. Okay. So I'm thrown off by Adam a little bit. Tweaks me a little bit. All right, let's get back to the story. So she's going to buy the property and she's going to live there instead of renting. Okay, let's see what I was going to do next. And I mentioned, of course, the insurance on the property is going up in value. The taxes on the property are going up in value from inflation, and the maintenance on the property are. But the principal and interest goes away. Here's another super interesting thing that happens with the principal and interest part of the payment. With rents, we all know that the rents are going up over time. You know, each new lease renewal, rents are probably tweaking up a little bit to keep pace with inflation. However, when you get a mortgage on a property, Jane realizes the principal and interest part of that payment is fixed for 30 years. So if you think about it in terms of what inflation does, the payment actually is in today's dollars, but over time, today's dollars are worth less, and so the payment really looks like it's going down. It's really twisted to think about that, but that's really what's going on here. Okay, so I'm going to show you a couple charts, and I'm going to just turn off some of these. I ran a couple different scenarios for you so that you guys can see what's actually happening, and we can compare them. So she's going to think about what happens if I'm renting, what happens if I'm buying, what happens if I stop working after 10, 15, 20 years, and I just sort of live off my investments? Do I run out of money? What happens there? And so let's take a look at Jane's situation and figure out what's happening with her. Okay, so if she decides from gross paychecks she's going to rent, then this is what her paychecks look like over time. She's getting regular raises, and her paychecks are going up with inflation over time till eventually she gets to the point where she retires. She no longer has income from her job, and so her income goes to zero, and she lives out the rest of her days. Okay? So if this was the case for her, this is her income over time. If we adjust for inflation, it looks like it's the same $3,333 per month that she's earning. That's inflation adjusted. So she's just keeping pace with inflation over time. Okay? Now let's go back to raw dollars so you can just see this. If she is a homeowner, this is what it looks like. And I'll show you, a homeowner gets to stop working earlier. She reaches that point where 4% safe withdrawal rate kicks in. She no longer has to work, and she's able to retire earlier. And so you can see, we'll go over what that is in numbers here in a second, so you don't have to count it. But realize that she's able to stop working earlier if she's a homeowner. Okay? So you can see that difference here. Now, if she had actually stopped working after 20 years, that's what it would look like. I'll compare that to the homeowner one. So the yellow line right here is the one where she stops working after 20 years. The 15-year line, this is when she stops working after 15, and this is when she stops working after 10 years. So you can see she's just earning her paycheck, and that's where she stops working. So I'm going to turn that one off. Okay. This is a really interesting one. This one is her personal expenses over time. I'm going to turn off a bunch of these. And let's look at the one when she's renting. So if she's just renting a property, her personal expenses, $22.10 per month, just increases because the rent's part of that, her food's part of that, whatever it is, it just keeps increasing over time. If you adjust for inflation on that, you could say that, whoops, it just stays fixed. All it does is she's maintaining the same standard of living she's having today. It is increasing over time because of inflation, but it's really the same dollar amount in today's dollars as it is right now. Okay, so that's kind of an important point there. Now, if she's a homeowner, it's actually different. And let's take a look at what's happening here. If you look in raw dollars, non-inflation dollars, you could see the first month, that's when she bought her property, she has a little bit of a discount. Yeah, GN, yeah, the software layers multiple scenarios to compare things. Yep, that's exactly why it's cool. Wait till you see the Monte Carlo stuff. It's going to blow your mind. Okay, yeah, we'll do that in a little bit. Okay, so here it is. Basically, that first year, she has the first month rather. She has a little bit of a discount because when you buy a house, you don't pay a mortgage payment the first month. Yep. So basically, that's what happens. And then she has her expenses increasing over time with inflation. But here's the interesting thing. Eventually, she gets to the point right here. It's about month 360 when she actually pays off her property and she no longer has her mortgage payment. And so the cost for her personal expenses actually goes down. Now, she could choose to live a higher standard of living and just spend more money, or she could choose to keep saving that and the savings will help her. Okay? So here's what's interesting though. If we adjust for inflation, it's going to blow your mind when you see what happens for someone who's a homeowner because of that principal and interest part of her payment being fixed. So when she bought her property, yeah, the first month is definitely low. The second month, though, when she's buying it, I'll zoom in. Second month, though, is pretty high. But why are her overall inflation-adjusted expenses going down? It's because that big part of her payment, the principal and interest part of her payment, is fixed. And over time, because of inflation, that looks like it's less dollars in today's dollars. And so it looks like that's actually lower each month. Taxes, insurance, and maintenance are all going up, but her principal and interest is not. And then eventually it goes way down. And so her expenses to live later on are much lower than somebody who is renting. That's the renting one. And you can see this difference over time is huge. Huge. It's like $900, right, in today's dollars. But it's a big difference, okay, because her amount of money. So it's really, really crazy. This is her work in different times because that's all the same. Okay, so we're going to skip that. So here's another interesting chart showing you how much she's actually saving. So if she was just a renter, she's saving about $500 a month in inflation-adjusted money, until eventually she stops working and then she's not saving that anymore. And she's living that negative $2,200. She's pulling from her savings that $2,200. But if she's a homeowner, she actually is saving a little bit more each month because she says, hey, I have this amount of money that I've set aside for living, but really my money that I have for this mortgage payment, it's not as much as I need, so I can actually save a little bit more. So it's actually even better. Then eventually the house gets paid off. She's able to bump her savings a little more, and then she quits her job, and she's able to pull out less money because she doesn't need that anymore for her mortgage payment. Okay? And you can see the difference here for somebody like quitting their job at different times. You can kind of compare all those. All right? All right. So let's take a look at this retirement stuff. When can she retire? These are the 4 different times that it takes to achieve their goals. Now, before I go into this, I need to tell you a couple things. I didn't assume that the stock market rate of return was fixed. It's not like I said, we're going to use 8% return on her money for the stock market. And it's going to be that the same for ever. What I said was, I'm going to go look at historical data of the stock market. And I went to the Bogleheads website and I pulled down Simba's spreadsheet of returns on a bunch of different stocks and bonds and things like that. And what I did is I looked at all of Simba's numbers, and I forget the exact range of dates. I can look it up if anyone really needs it. But when I looked up ranges, I think I went through 2017, and I went back as far as they had on there. And I said, what has the range of returns been in the stock market? What's the high been? What's the low been? And then what is the standard deviation? I don't want to get super complicated with math, but I looked at what the normal range of values had been. And I used that to determine what the stock market would be. So if we ran this scenario again, depending on how the stock market did, because it's random, she may be able to retire earlier, or she may not be able to retire at all. Sort of like what they did with the Trinity study, except I did mine a little bit different. Okay, so in this case, you could see these these erratic lines. You could see the crazy. This line is like all jagged. That's because the stock market rate of return is variable. So if we ran this again, it may not be this exact number, and she understands that. All right. So in this case, this one example, she was able to retire in 32 years. That's the point, as a homeowner, that's the point where she has enough money invested in the stock market that using a 4% safe withdrawal rate, she can replace her income that she's been living on, that 85% of the $40,000 she's been living in. Okay? If she was renting, it would have taken her, in this example, and of course the stock market's going to have some play in this, 512 months or 42 years, a decade more in this example. Okay? And so you can see the range of where she's doing that. Now, if she stops working after 20 years, she actually runs out of money. So in this case, she stops working after 20 years and starts living on her investments. And unless her investments do phenomenally well, much better than historical numbers have suggested, she has like really good chance, like things really go in her favor, she runs out of money. If she stops working after 15 years, she runs out of money earlier. If she stops working after 10 years, she runs out of money even earlier. In the case where she waited until she had the full 4%, in this case, she was able to reach the point where she has enough money to retire and her portfolio balance increased a lot. In the case where she was a homeowner, same thing, it happened earlier, but it increased a lot too. Is it possible for her to get to the point where she has a 4% safe withdrawal rate, where 4% of her invested amount in the stock market is enough for her to supply the money she needs to live on, and for the stocks then to go against her and for her to run out of money? Yes, it totally is. Think about this. If she just got to this point where she reached the point where she could retire, and then we had COVID, and COVID dropped the market 30%, she no longer has enough where she would be able to retire that. And if the market didn't recover and she kept pulling money out of that, eventually she would run out of money, right? And so that's the scary thing about a lot of this stuff, is we're playing with like chance. We don't really know what's going to happen in the market, okay? So that's the goal stuff. This shows you this her total account balances, which because she only has like one property, it's the majority of what's going on here. So I'm going to skip that for sake of time. But there are a couple things I do want to show you. Net worth is the same thing. All right, so here's some interesting stuff. So this shows you, Jane says, hey, listen, I realize the stock market can go up, it can go down. We really don't know how it's going to perform. And how it performs is going to have a major impact on when I can retire from the 4% safe withdrawal rate from my money invested in stocks. So she says, let me do this. James, I'm going to go use your software, and I'm going to run my scenario, let's call it 100 times. And then I'm going to look at the results from those 100 times, and I'm going to see how I did. So what she basically did, and I don't want to go into too much detail because I can go down a rabbit hole here. But this is the scenario she ran where she was saying, hey, I'm saving 15% and I'm a homeowner. She could make a copy of this, and now it ran it again, and she could actually see the difference between the two. So if she did another copy, we'll just run like 3 or 4 copies of this. And every time she runs a copy, it shows up on here as another one. So let's say if I go, and I'm going to chart these now. I'm going to go chart this. And right here, it allows you to pick the other ones. Let's see. Did I do something wrong here? Oh, I was hitting the wrong button. I was hitting refresh instead of copy. All right, so here we go. You're going to hit copy. And we'll run it. And that just ran another copy. I'm going to make another copy. And I'm going to run it. All right, so now I got 3 of these. Now I'm going to go and I'm going to add in the 2 copies, and we're going to compare this. So we just ran 3 different versions of the same thing. And you can see clearly that each one's a little bit different. The stock market does better in one, stock market does worse in others, and we can see the difference. And if we go to the goals, we can compare the 3 goals. And we can see that one of them took 404 months, the other one took 417 months, and the other one took 421 months. So there's a variation in this. And if we kept doing this 100 times, we get a range of values. And so it shows you here a visual summary of how long it takes for you to achieve that goal of having enough for a 4% safe withdrawal and being able to retire. And so this is 100 different runs summarized. And this chart shows you what percentage of the 100 runs achieve the goal so that you had that safe withdrawal rate. And so basically at month 350, 3 out of the 100 runs had enough money for her to retire. If we go to month 400, 43 out of the 100 runs had enough for her to be able to have a 4% safe withdrawal rate and retire. If we go to month 450, 87 out of the 100 runs had that. And eventually, when you get to the point of month 542, 541 or so, then 100% of the runs allowed her to have enough money for retirement. And so this shows you a quick summary of that. So the visual here shows you like what percentage, and it doesn't have to be 100. Like you could run this 1,000 times and get a really good range of stuff. And so you can see the range of how many achieve what goal. So here's like the showing the different ones. I'm going to show you a comparison though. This is her renting. So the renting one, you could see that it takes longer for her to get to the point where there's more certainty of having enough. But let's just compare the 2 different ones. Let's compare her as a renter versus as a homeowner and see like what percentage of the runs get to be the point where you have 100% certainty of you being able to retire. And the blue line here, this one, is the one that has her as a homeowner. The red one is her as a renter. And you could see that, let's say we say, okay, month 400, 7% of the runs as a renter meant that she had enough to retire. 43% of the runs had enough for her to be able to retire if she was a homeowner. You jump up here, and month 450, 80% of the runs, 87% of the runs had enough for her to be able to retire, versus 40% of the runs had enough for her to be able to retire with her renting. And you can see it takes a long time for you to get to the point where it's 100% of the runs had enough for her to retire as a renter. This is just the same charts and superimposed over each other. Those little jagged kind of like dotted lines, those are actually these same lines below. They're just superimposed. Okay? And L says, this software is great. Thank you. I appreciate that. I wrote it myself. Okay. So you can kind of get a feel for like how that works. This shows you total account balances. I'm not going to go into that. Total account balances for doing that. Here's the goals for her with stopping working after 20 years. And you can see she never gets to the point where 100% of the runs allow her to retire. In fact, she only gets to the point where only if the stock market really, really goes in her favor is she able to get the point where she's able to achieve her goal. It's a very small number of the runs. Her chance of being able to retire, stopping working at 20 years and not running out of money is really low. Really low. And you can see that here in this chart. Okay, I don't want to mouse over because it blocks it. But you can see that the chart actually is only a certain number of those shaded areas that get over the 100% goal line. So that shows you that only a few of them actually succeeded. The other ones, she ran out of money. Not good. All right, I think that's what I wanted to cover. Yeah, Rick, the software is available on the website. It's realestatefinancialplanner.com. So that is the story of Plain Jane. Plain Jane decided she wanted to invest in stocks and be able to retire. And she determined that she could do it. She's putting away 15% of her income, and she's able to actually achieve financial independence. When we compare in other story hours, so we've done, I don't know, this is the third one so far. In other story hours, we've seen how long it takes some folks to actually be able to stop working and achieve financial independence. Like I think last week we talked about a guy who was investing. It was Bad Luck Bobby. Remember Bad Luck Bobby? Bad Luck Bobby started investing at the peak of the market, and the real estate market was going down as he was acquiring his properties. But he still stopped working after, I think, 10 years in our model and was able to stay not working after 10 years. Kind of crazy. GN says, curious, is there a way to run comparison of house hacking versus renting and acquiring multiple rentals for a cash flow goal? Yep, sure is. This software allows you to go and compare any investing strategy you have versus any other investing strategy, whether it's stocks or any variation of real estate, buying properties free and clear, buying properties and then paying them off with cash flow earlier, buying properties, investing in stocks, and as soon as you have enough in the stocks to be able to pay off a property in full, doing that, buying properties, refinancing them to re-leverage them up and buy more properties. And so it's like freaking crazy over the top. Any type of modeling you want to be able to do, we can do things where you buy more properties than you need, and the software will actually say, okay, if you sold off 4 of your 10 properties, you can actually pay off the remaining 6 and actually achieve financial independence and retire. And you can compare that model to, let's say I don't do that and I hold on to the properties for 2 more years and then I do that. You can do any freaking craziness you want. And that's why I wrote it. And not only can you do this comparison saying appreciation is 3%, rent appreciation is 3%, inflation is 3%, you can make all of those numbers variable or do a range of values and say appreciation is somewhere between -6 and +9 with a standard deviation of 3, so that most of the time it's around that 2 or 3%. And yeah, so it's like really, really crazy stuff that we can do. So, yep. And you can have rent be on its own measure. You can have appreciation be on its own. You can have, interest rates vary. What happens if you're going and buying in a rising interest rate environment? So Gian says, seriously, this will take all emotion out. It does on first glance, but then you realize you're basing this on assumptions. And are my assumptions real? So really what it comes down to, Gian, I'm going way off topic. By the way, story time's over. I mean, I'm happy to answer any questions yet, but is really just more discussion about some of this other stuff. This will take emotion out. And you think at first glance this does, right? But then you don't really know what appreciation is going to be. You don't know if we're going to see COVID again. You don't know if the stock market is going to outperform real estate, or we're going to see a rent suppression, or interest rates are going to get crazy. And so you have to start thinking, okay, this is my model. Here's where I am. Here's where all my stuff is. Now let me go and play with 7 different strategies I can go from here. Should I pay my properties off early? Should I not pay them off early, take all that cash, hoard it for another buying opportunity later on in case the market goes down, and invest in stocks in the meantime? And then you can take that same exact thing and say, well, I'm not going to invest in stocks. I'm going to invest in bonds in the meantime. Or I'm not going to do that. I'm going to invest in a business in the meantime. Or I'm going to do this and I'm going to actually pay off my properties early. There's all sorts of variations. And then you got to run all those and say, do I feel adequately prepared for almost any eventuality? And is that okay for me? And then as things change, you go back through and you rerun things and you say, okay, 6 months later or 3 months later, these things are different now. The environment is different. Let me go reevaluate with where I currently am. Let's take a snapshot of what actually is true. And then let's run some what if scenarios into the future. What if we do see hyperinflation, but property values don't go up as fast as they should? What does that look like? Then it helps to be a debtor. And so you can look at all these things and really evaluate them, but it's going to take some time for you to go in and really start modeling stuff and really start to understand things. And that's part of what we're talking about with Storytime. Storytime is my way of being entertaining to you, but showing you different variations of different people and some of their beliefs, like Plain Jane and her kind of like aversion to debt. Not everyone is as anti-debt as Plain Jane is. Some people are like, I'm okay with a couple rentals. What does a couple rentals and then with doing stocks for the rest of it look like? How does that change things? What happens if we see market corrections, which we can program randomly, right? So you can see a lot of this stuff, and the story time is a way for me to give you lots of different examples, hopefully in a somewhat entertaining, but also educational and also insightful. This is what happened to her. This is what happened to him. This is how it could have gone down. Let's take a look at a wide variation of these things. All right. GN says, definitely better than sitting and waiting and hoping, though. Yeah, I agree. Yep. Any final questions? Otherwise, I'm going to end the call. And I do appreciate you all coming on. And for all of you that did not advertise your business, thank you for not doing that. Throws me off a little bit. Anything else? Was this helpful? Even though it wasn't real estate, for those of you that are like into real estate, right? Like this is a good comparison of, well, what does it look like if I'm not doing real estate? At least that's how I thought of it. It's like, I want to see what the baseline is if I'm going to, because occasionally you wake up and you're like, is all this extra work of acquiring properties, dealing with financing, dealing with tenants, dealing with property managers, dealing with contractors and doing this, is that worth it? How much more time can I save than if I just took that same amount of money and I go and I actually put their stuff in, like the stock market or the bonds or whatever it is that we're going to do? Is it worth all that extra effort? Maybe. You got to make that decision on your own. But now I can show you numbers and show you ranges of results, and then we can run real estate stuff and you can compare them and say, yes, I'm better, or no, I'm not better, or I don't know. So it's kind of crazy to think about that. Let's see here. Got some other messages. Ashanti says, great approach, love story time. Will you help me take a look at my story? Probably, yes. I mean, I'm still trying to figure all that out as to whether I'm willing to do that, but probably yes. If you want to reach out to me, we could talk about what that might look like. Hunter says, thank you, James. Interesting stuff. Yeah, you're very welcome. Elle says, do you typically charge your clients to run scenarios for them? Again, relatively new. I probably could do something like that. I'd prefer to help you enter your stuff and then walk you through some basic stuff of how it works and then set you loose to be able to kind of play with stuff. And then I'm happy to get back on there, almost like a tech support capacity of helping you understand, interpret, and make sure all the data is right and doing that. So that's more of what I probably would be comfortable with. But yes, so reach out to me. We're happy to do that. Patrick says, thanks, James. Appreciate your work. Yeah, you're very welcome. Rick says, great presentation. Suggest you have light in front of you so that we can see your expressions. Yeah. As you'll see, Rick, the content tends to be really good. Production value seems to be really low. So, but I do hear what you're saying. It's part of it's backlit and it's morning, and I have morning light in my my office for now. But yeah, I do hear you, and I definitely appreciate it. Gian says, thanks, impactful. Yeah, you're very, very welcome. Stacy says, thank you. You guys are all very, very welcome. Glad you enjoyed it. I'm going to end the call, but I do appreciate you joining me. I'll try to put the recording up there in case some of you want to be premium and go ahead and look at stuff. The recording will be there for you. So thanks again for everyone who came on. I will talk to you all soon. Bye-bye for now.